Alright, so the second component of aggregate expenditure is investment, I. So investment is basically expenditure to satisfy future wants. This is a primary difference between consumption and investment, where consumption is to satisfy current wants and needs. Investment is to satisfy future wants. Investment is basically change in capital, which means that goods and services through investment are not sold to consumers. So investment can be divided into two broad categories. One is household and the other one is for producers. So households is basically a residential investment that is creation of new homes. So if consumers take loans from banks and other financial institutions and invest it to create new homes, to build new houses, new apartments, new buildings, this is residential investment. The returns through residential investment could be in the form of rents that can be earned by renting out those apartments, those houses. For investment through producers is basically can further be divided into two. That is change in current assets and change in the fixed assets. So current assets are basically those whose gains and benefits can be realized within 1 year. So current assets can include, say, raw materials. That is, producers will use those raw materials to produce finished goods, which can later be sold to consumers. On the other hand, fixed assets basically include machinery, warehouse, equipment, right, which are utilized over a few years, right? Basically 3 years, 4 years, 5 years. That during that time their benefits are realized. So current assets that provide benefits within a year, fixed assets that provide benefits more after a year, or basically after a few years. So if I sketch the investment function, the important thing that I need to know is that there is no relation of investment with respect to Y, that is with respect to income. So on the x-axis I have income, on the y-axis I have investment. So if I sketch the investment function will be one horizontal line. This means that investment has no relation with equilibrium income. So income can rise, income can fall, but this will not cause a change in investment. Then what is investment dependent on? Investment is basically primarily dependent on marginal efficiency of capital, right? MAC. So marginal efficiency of capital can also be called the rate of return on investment. Now, the idea is that for a project to be successful, to be beneficial, to yield higher gains, MAC, the marginal efficiency of capital, needs to be greater than the interest rate. So rate of return is basically revenue minus cost, right? And this cost is basically the cost of capital, or interest rates denoted by R. So if interest rates fall, investment will rise, because if interest rates fall, the marginal efficiency of capital will be greater than the interest rate, resulting in a rise in investment. So interest rates basically represent the opportunity cost of investment, right? This means what could have been earned if that money was saved rather than invested. So if interest rates, say, fall, this means that the returns on investment, the returns on savings will also fall, right? And if that happens, this will lead to a rise in investment, right? So primarily, investments depend on the rate of return, right? So if the marginal efficiency of capital is greater than the interest rate, if it exceeds the interest rate, the project or the investment will be profitable. But there are other factors that determine the level of investment in an economy. Other factors could include the level of profits, because investment can also be financed from the pool of retained profits. So if the current level of profits are high, this means that there are really more retained profits to invest back into the business or into other sources of investment, right? So that's one factor. The other factor could be cost of capital goods, right? So if there are higher import duties or the exchange rate has depreciated, which means that imports are expensive, resulting in the cost of raw material, the cost of capital goods to rise. This makes profitability of the investment project fall, so investments also fall. Other reason could be technological changes, which makes capital goods more productive, causing an increase in the marginal efficiency of capital. One factor could be expectations. So Keynes believed that the animal spirits of businessmen are crucial in determining changes in investment. So let me write this down. Animal spirits. So basically, if businessmen or entrepreneurs believe that in the future costs will fall and revenues will rise, investments will change, and investment will be subject to certain changes based on the animal spirits of businessmen. Lastly, government policy also plays an important role in determining investment, right? If the government is in support of new startups or is encouraging more and more entrepreneurs, they will provide subsidies, they will provide training or grants in the form of new technological equipment, in the form of skilled training for skilled labor. This all will cause an increase in investment. And of course, changes in interest rates. If interest rates fall, it makes saving unattractive, causing a rise in investment. So this is all about investment. In the next video, we'll talk about government expenditure.